Good morning. We apologize for the delay. We are going to start now. My name is Bob Stein. I'm the Executive Director of the Institute for Entrepreneurial Excellence at the University of Pittsburgh. Thanks for joining us today for our Economic Outlook Update with PNC Chief Economist Gus Faucher. It was a little more than a month ago that we had our last economic update before the whole COVID-19 crisis completely unfolded, and the world has certainly changed since that time. I'd like to thank PNC for being our partner and sponsor for today's program, and we're excited to have Gus here today to give us an update on his economic outlook. I'd like to introduce Gus. Gus is the Senior Vice President and Chief Economist of the PNC Financial Services Group, and he is the Chief Spokesperson for all economic issues for PNC. Gus, I'm going to hand it over to you.
All right. Thank you very much, Bob. I appreciate the opportunity to speak to everyone this morning. Sorry about the technical issues that we're going through. I think everybody is kind of in the same boat. So if we want to pull up the slides and get started here. Okay, and then I'm a little behind on my computer screen, so I'm not sure. But if you want to go to the first slide that shows the table of the stock market declines, the next, okay. All right, I'm assuming that we're there. So we have seen about a 30% decline in the U.S. stock market between, roughly, over the past few weeks. Stock prices are up since then. But that big decline in stock prices, that is consistent with what we would typically see in a recession. If you look at the numbers in red, these are all the stock market corrections since 1971. If you look at the numbers in red, those are the larger declines of 20% or more. And you can see that most of the time when we have a smaller correction in the stock market, we don't have a recession. And most of the time when we have a larger correction in the stock market, we do have a recession. So that 34% decline that we saw from February through roughly a couple of weeks ago is consistent with a recession in the United States. If we want to go on to the next slide, please. The National Bureau of Economic Research dates recessions and expansions in the United States. And according to the NBER, the expansion that literally just ended, probably a few weeks ago, was the longest expansion in U.S. economic history at 129 months, more than 10 years. Typically, if you look at these recessions in the U.S., the recessions are caused by imbalances in the economy. So if we think about the Great Recession, that was caused by problems in the housing market, and then that spread to the financial system. If we think about the recession in the early 2000s, that was caused by the bursting of the tech bubble. If we think about the recession that we had in the early 1990s, that was caused by problems in the savings and loan industry, and that's in commercial real estate markets. If we think about the recession that we had in the early in the early 80s, those are the double dip recessions. Those were caused by double-digit inflation and the Fed aggressively raising interest rates in response to that. It's very different this time around. This is caused by something completely external to the economy, and we don't have a good guideline for how this is going to end. This recession came on very quickly. The NBER defines recession not as a two-quarter contraction in GDP, but at a broad-based decline in economic activity, looking at a lot of indicators, GDP, but also consumer purchases, the labor market, wholesale sales, manufacturing output, all of that. And I think we're likely to see that the NBER will define this as a recession once we start to get the data on it. If we want to go on to the next slide, please. So we have seen, first of all, the Federal Reserve has responded very aggressively to this in two quick actions in emergency meetings in early March. They cut the Fed funds rate from a range, between 1.5% and 1.75% down to basically to zero, back to where it was during the Great Recession and the initial stages of the recovery from that. That's indicated in the falling, very sharply falling interest rate on a 3-month Treasury bill, a short-term U.S. government security. We've also seen long-term interest rates decline as well. So if you look at the orange line, that's the interest rate on a 10-year Treasury bond. That's not tied as much to what's going on in the short term, but that's based on expectations for where investors think the U.S. economy is going to be going over the next 10 years in terms of inflation, in terms of growth, both the U.S. and globally. And you can see that we've had a very sharp decline in long-term interest rates as well. And in fact, we saw that interest rate on the 10-year Treasury bond move to its lowest levels ever in March, and in fact below where it was during the Great Recession in 2008, 2009. So there's been a very swift financial market response, and financial markets are indeed expecting a very severe economic contraction in the near term. And similarly, if we want to go on to the next slide, we've also seen a very sharp decline in stock prices. So we've seen the S&P 500, as I mentioned, it fell by about a third, although it has bounced back a little bit over the past couple of weeks. And then what we call the VIX index, that orange line, the CBOE volatility index, that's a measure of how much stock prices are moving up and down. And we've seen, that volatility jump back to the levels that we saw during the Great Recession. So there's been huge swings in the stock market, both up and down. And I think that's just indicative of all of the confusion and all of the uncertainty that is surrounding the coronavirus pandemic, the public health response to it, the economic implications of all that, the implications for companies' earnings and so forth, the stimulus bill, what we've received, the packages that we've received from the Federal Reserve, all of that. And there have just been huge swings in stock prices. And I think investors need to be prepared that volatility is going to remain very, very high in the near term until we get a better sense of how long this crisis is going to last, how long restrictions on movement will be in place, social distancing, what the economic response will be, whether job losses turn out to be permanent or temporary and so forth. But just a huge amount of uncertainty out there in the U.S. economy and in the financial markets. If we want to go on to the next slide, the U.S. economy was in decent shape heading into this. We had economic growth, depending on what measure you were looking, at about 2% over the year through the end of the 2019, excuse me. That's about what the economy can grow at over the long term. So we had steady, sustainable growth. And I think we would have likely have seen the expansion continue throughout 2020 if we did not get that coronavirus pandemic. If we want to go on to the next slide, please. This chart shows the shares of GDP, U.S. economic output, in particular the shares that I think are most at risk. Just as a quick reminder for those of you who took macroeconomics in college, GDP is consumer spending plus investment plus government spending, and then you add in net exports. We don't include imports here. That's about 15% of GDP, so the shares add up to a little bit more than 100%. But I estimate that about half of the U.S. economy is at risk right now. So if you look at the top four shares on that chart, so all other consumer services, so that excludes healthcare, housing, and utilities. That's the blue piece. That's about a quarter of the economy. I estimate that a lot of that spending is at risk. So that's entertainment spending, travel and tourism, financial services, personal services, so things like dry cleaning, haircuts, and so forth that people aren't getting because of the coronavirus pandemic. So that's at risk. Private investment, so that is business investment. So business investment, commercial construction, equipment, investment in housing, that's at risk. Exports, the green portion, that's at risk because of a global recession. And then consumer durables, the purple slice, that's about 7% of the economy, excuse me. That's purchases of things like cars, appliances, RVs, those goods that are expected to last more than 3 years. So, for example, we saw, a huge decline in vehicle sales in March because many car dealerships were shut down at the end of the month, and we're going to see an even bigger decline in April because they're going to be shut down for the entire month. So about 1/2 of the U.S. economy is at risk. There's less concern healthcare spending, although we've actually seen declines in some aspects of healthcare spending. That's the yellow piece, as well as housing and utilities. Non-durable goods, that's things like food. Obviously, food sales have gone up. Clothing sales, maybe a slight decline there. there, but less important. And then government, the black portion, that's a big piece of, I'm sorry, government is the red portion. That's a big piece, and obviously that share will increase as we see the federal government respond to the coronavirus pandemic with increased purchases of health products, support to laid off households and small businesses that are closing. We want to go on to the next slide. The job market was pretty good heading into this. We were adding about 200,000 jobs per month on average. We were absorbing slack in the labor market. The unemployment rate was down to 3.5% in February. And then we got the March jobs report, which was very, very bad. We lost about 700,000 jobs over the month. We saw the unemployment rate increase to 4.4%. And it would have been even higher, except that 1.6 million people basically dropped out of the labor force. They were laid off, they quit looking for a job and just stopped looking entirely. And then also, according to the Bureau of Labor Statistics, there were a number of people who counted themselves as employed. They were on temporary layoff. They counted themselves as employed when they should have been counted as unemployed. So the actual unemployment rate in March was much, much higher than the officially reported 4.4%. And the even bigger concern, if we want to go on to the next slide, I'm sorry, you can see there that we lost 700,000 jobs in March. That is basically at the close to what we had during the worst of the Great Recession. And if you think about it, the Great Recession, we started off with small job losses, and then over a period of a year saw job losses of 600,000, 800,000 or so. Here we went from a situation where the U.S. economy was adding about 200,000 jobs a month to 1 month, and we saw job losses of 700,000. So just an enormous swing in the economy. And the worst news is, if we go on to the next slide, that initial unemployment insurance claims over the last 3 weeks have just been, I don't use this term lightly, apocalyptic. Before this, a month ago, 5 weeks ago, we had initial unemployment insurance claims of 220,000 per month. So that many people were roughly losing their jobs per week. Were losing their jobs each week, and then filing for unemployment insurance benefits. A few weeks ago, 4 weeks ago, we saw that go up to 280,000. So that was a noticeable increase. Then we had claims go up to 3.3 million. So that's, more than 10 times higher than what we saw previously. Last Thursday, we got claims that were 6.8 million with revisions, and then this week we had claims about 6.6 million. If you look at this chart, first of all, note that this is a logarithmic scale. This is not your typical scale, so that means that each line is 10 times higher than what we saw previously. Claims over the last 2 weeks have basically been 10 times higher than any previous week we have seen. So previously, the record high for claims was about 690,000 in the 1982 recession. The last 2 weeks, it's been 6.8, 6.6 million, just huge numbers of claims. Over the last 3 weeks, we have seen initial unemployment insurance claims filed of almost 17 million people. 17 million people have apparently lost their jobs over the last 3 weeks. This is restaurants, travel, tourism, airlines, all that stuff, and it's spreading throughout the economy. So we have just seen really unprecedented job losses. When we get the April jobs report, it's going to show job losses that are far above the previous record, which was about 2 million during the end of the World War II, when we had demobilization and shutting down of defense industries. The unemployment rate will probably jump above 10% in April. That would be higher than what we saw during the Great Recession, may surpass the peak that we saw in 1982. And it's just, these numbers are really unbelievable, just the amount of economic dislocation that has taken place. And I think we're just going to, we're going to have huge layoffs. The question is whether these are going to be temporary or permanent, and we'll discuss that in a couple of minutes. We want to go on to the next slide. there are a couple of things that are positives for the U.S. economy heading into this. The first is that consumers are in pretty good shape. So if you look at the personal savings rate, that's the blue line on the left-hand scale. That's how much consumers are saving, each month out of their after-tax income. You can see the consumers were saving about 7 or 8% per month. You go back to before the Great Recession, those gray bars, it was much, much lower. The savings rate was 3 or 4%. So households are much better prepared in terms of having higher savings. And then they're also better prepared in terms of having much lower debt payments. So if you look at the orange line on the right-hand scale, that's the debt service ratio. That is things like mortgage payments, credit card payments, student loan payments, auto loan payments. All of those is the share of after-tax income. Heading into the Great Recession, that was above 13% as homeowners had borrowed a lot against their homes, and consumer borrowing was generally very high. Now it's below 10%, near record low. This data goes back to the early 1980s. So households have paid down their debts. They have less debt. They have lower interest payments because of lower interest rates. So all of that means that consumers are much better prepared for this than they were heading into the Great Recession, which presumably means that once we get through the initial dislocation, we get the stimulus from the federal government, that we should see consumer spending hopefully bounce back pretty quickly, assuming that a lot of these job losses are temporary, and that the stimulus is effective in getting to the people who really need it. If we want to go on to the slide after that, I'm a little more concerned on the business side of the equation, however. If you look at non-financial corporate debt as a share of the size of the economy, that's at a record high now, up above 45% of GDP. So businesses do have a lot of debt. The one that makes that less of a concern is that with interest payments low, if we look at interest payments as a percent of cash flow for non-financial corporates, that is not nearly as high as it has been in previous decades. So yes, businesses do have a lot of debt, but interest payments are fairly low. Interest rates have fallen further. We see the Federal Reserve making efforts to support lending to businesses. And so although absolute debt levels are high, those interest payments are a little bit less of a concern, but still many businesses are going to be squeezed as they see revenues dry up and find it increasingly difficult to obtain cash loans from the financial system. If we want to go on to the next slide, we did get a fairly substantial stimulus bill, $2.3 trillion. We're likely to get even more. It came in a lot of forms. There are small business loans that will turn into grants that will allow businesses hopefully to keep some of their staff. And just this morning, we got indication from the Federal Reserve that it is stepping in and helping expand that. So it should be beyond the initial, roughly $375 billion that was appropriated and that the businesses went through quite quickly. We're getting one-time stimulus checks for many taxpayers of close to $300 billion. We have expanded unemployment insurance claims of about $250 billion. That will hopefully replace some of that lost income that people are going to have because of job layoffs. State and local governments are going to be very hard pressed, but there's aid to states of about $150 billion. They'll probably need more than that. So the goal is that this will help replace a lot of the business and household income that is going to be lost from the social distancing restrictions on movement, so that when hopefully conditions alleviate somewhat over the next couple of months, that instead of having businesses closing and permanent layoffs, we have businesses that are able to reopen, that are able to rehire, that consumers won't have lost as much income because that will have been replaced by these government programs, and so that consumers will be able to spend once we get through this in what is hopefully a couple of months, depending on the public health response. The federal government's budget deficit was pretty large heading into this. Sorry, if we want to go on to the next slide, this is number 14. The federal government's budget deficit was large heading into this. We were running big budget deficits, even though the economy was doing well. But it's much more important to solve the near-term problems than to worry about the government debt right now. The best way to meet our obligations in the future for retirement programs, for infrastructure and investment for defense spending is to have a strong economy. So it's much more important that we spend the money now, that we get a strong recovery, that we have strong economic growth and a strong economy, and then we can figure out how much we need to provide for the baby boomers in their retirement, how we're going to fund that, how we're going to fund our other obligations. But those obligations are going to be much more difficult to meet if we don't have a strong economy 4 or 5 years from now. If we want to go on to the next slide, we've seen the Federal Reserve respond very aggressively. Not only have they cut interest rates, but they've also restarted some of the programs that we had during the financial crisis a decade or so ago. They're purchasing long-term treasuries and mortgage-backed securities in an effort to keep long-term interest rates low. They announced this morning an expansion of lending to small businesses. They are buying certain types of private debt that they have not purchased before, so municipal bonds, highly rated corporate debt. So the Fed is doing what they can to make sure that credit flows continue so that businesses that have temporary disruptions are able to get access to credit so that they can borrow to fund their obligations in the near term. And then again, hopefully once the restrictions on movement are lifted in a month or two from now, that business activity can restart, that we won't have a lot of businesses going on under, not because they have, structural problems, but just because of this unprecedented shock to the system, and that they can borrow enough to get through this. I get a lot of questions about inflation and whether we should be worried about inflation because of all the government spending and the Fed efforts. You should be much more worried about deflation. That is, prices that are falling broadly across the U.S. economy than inflation. This chart, this is page 16, this shows what financial markets think inflation is going to be 5 to 10 years from now. This is based on the difference in interest rates between regular long-term treasury bonds, so what it costs the federal government to borrow for 10 years, versus there's something called an inflation-protected security. It pays inflation plus a rate of interest, and we can use that to devise financial markets expectations of inflation. You can see that over the past couple of months, financial markets expect inflation to be much lower 5 years to 10 years out than they were just even in late 2019, early 2020. What the Federal Reserve wants to avoid at all costs is deflation. That is when prices are falling broadly across the economy. That can wreak havoc on an economy. You have people and businesses putting off purchases because they think prices will be lower in the future. It makes it difficult for the Fed to lower interest rates. It is difficult for wages to adjust. So right now, financial markets are more worried about low inflation than high inflation. And I think the Federal Reserve really wants to avoid deflation, which would be disastrous for the U.S. economy. This is slide 17 is our March forecast. Our April forecast is, to be honest with you, going to look even worse. But you can see that, we expect to see a substantial contraction in the U.S. economy in the near term. It is going to be steeper than what we saw during the Great Recession over a much shorter period of time. So during the Great Recession, we saw GDP fall about 4% over a period of about 6 or 7 quarters. We're going to see maybe a 6% contraction over a couple of quarters. So it's going to be a much steeper decline over a much shorter period of time. The unemployment rate, here I show it peaking at somewhere a little bit south of 7% over the next couple of quarters. Given the claims data that we've gotten, given the very poor March employment report, I think it's more likely to peak at above 10% sometime, probably in the third quarter of 2020. But hopefully with the stimulus package, with the and probably additional stimulus from the federal government, with aid from the Federal Reserve, with some businesses able to stay open through this and resume normal operations in a couple of months, the expectation is that we will see a strong economic recovery later in 2020 and in 2021 and into 2022 that will allow for a rapid resumption of job growth, a rapid decline in the unemployment rate. But that depends on a lot of factors, in particular that the public health response is good and that we are able to reduce social distancing, that we don't have another outbreak of the coronavirus later this year and in 2021. That assumes that the stimulus is effective, that the Federal Reserve is able to make credit, is able to keep credit flowing, and that many small businesses are able to reopen and rehire their workers. So there is, our expectation is that we will enjoy a strong recovery after a very steep recession, but there are a lot of risks to that. If we go on to the next slide, slide 18, Pittsburgh has a little bit less exposure to this downturn. We do have more exposure to low energy prices, and we've seen energy prices plummet, but we have less exposure to industries that are more vulnerable to the downturn. So transportation industries, employment services, that's temporary employment, which is going to take a big hit, leisure, hospitality, travel. And so I think that Pittsburgh will not escape this recession. We'll still see a severe recession in Pittsburgh, but it should not be quite as severe, as a recession that we saw in the rest of the United States. And then if we want to go on to slide 20, we'll be, slide, I guess it's slide, well, I have two slides 19. It's the last slide in the presentation. You can read our March write-up at pnc.com/economic reports. We'll have our April write-up up in a week or two. We have a write-up on the latest employment data and so forth. And then you can follow me on Twitter at Gus Faucher PNC. And then, I don't know, Bob, I can't see let me see if we have the questions. We have some questions here. Okay. State of Pennsylvania going to cope with loss of revenue due to COVID? Bob, do we have time to take questions?
We have time, Gus. Go ahead.
Okay. So I'm just going to go through the questions that are showing up on my panel. So loss of revenue due to COVID-19 for the state, that's going to be a real problem for states and localities. Pennsylvania is dependent on the state tax, the sales tax and the personal income tax. Both of those are going to take a substantial hit. Allegheny County, earned income tax, property tax is a little bit less of a concern, but the 1% sales tax in Allegheny County, and a lot of states and localities are going to take a huge hit to their budget. At the same time, they're seeing spending go up in terms of the healthcare response. And that's an area where we have seen the federal government step in, and I think we will likely need more aid from the federal government to states and localities to help fill those budget holes. The concern is that when we get into the recovery, later this year in 2021, we see states either raising taxes or cutting spending to help alleviate budget holes that were caused by this recession, but that would make the recovery weaker. So I think one thing that the federal government can do is they can borrow for 10 years at, 0.7% or something like that. So it makes sense for the federal government to help states and localities get through this crisis so that we can have a stronger economic recovery. Let's think. What markets will be good in southwestern Pennsylvania this year? I think it's going to be a tough situation for commercial real estate in the near term. Office space, many of us are working from home, so I think we may see a permanent reduction in demand for office space going forward. Businesses, they may want to spread out their locations. In terms of manufacturing activity, maybe a little bit better. Businesses may want to diversify their supply chains, so they may want to bring production that they had overseas back to the United States. They may want to bring they may want to, if they have one manufacturing facility in the States, they may want to make that 2 or 3 so that they have some protection against something like this, because we've seen that the geographic dispersion of the coronavirus is not evenly across the country. I think that single family housing is likely to come back a little bit stronger. The single family market was very strong going into this. Mortgage rates remain very, very low. And I think that, perhaps this may emphasize the need for family, and that people maybe want to have a little more, want to invest a little bit more in housing. But hotel construction, I think, is going to be very soft in the near term. We've had a lot of hotel building in Pittsburgh. The vacancy rates have dropped tremendously. And so I think that, it is going to be a tough outlook for commercial real estate markets going forward, perhaps out of a few pockets of strength in manufacturing facilities. In terms of the PNC loans, I can't comment on that. The Fed intervention, economic activity. This is the question from Sarah. How does this federal intervention material impact economic activity other than providing liquidity to public debt markets. The actions that the Federal Reserve has taken are designed to encourage banks to make loans to small businesses, to make loans to big businesses so that they can meet their payrolls in the near term. They can not literally keep the lights on, but keep their businesses open so that when economic activity restarts, they are able to restart pretty quickly and rehire their workers. The Paycheck Protection Program that's in the stimulus, the CARES Act, the stimulus, that is designed to encourage businesses to keep workers on their payrolls. Now, that only provides 8 weeks of support. We may need more than that. We may need more money flowing into that program. Demand has been very, very high. But I am hopeful that between the actions that the federal government has taken and that the Federal Reserve has taken, that is indeed enough to allow many businesses to get through this and then restart operations once we see restrictions on that. In terms of the risks and the downsides, we talked about that. I do not think that this is going to cause high inflation in the United States. I don't think that, we need to worry about the federal government's budget deficit and the national debt over the long run, but I think it's much more important that we address the current crisis now and then worried about those things. In terms of the PNC comments on PPP loans, I can't really comment on that. That's more of a banking issue. A dramatic change in a global economy to a more domestic economy. We may see some businesses moving supply chains back to the United States, but globalization is here to stay. I don't think that there's any question but that the globalization may take a hit in the near term, but I think over the longer run, we will see continued integration of global economies. And I think to some extent, this demonstrates the need for international cooperation. I think that the cooperation between the United States and China, between the World Health Organization, I think that cooperation was not there, and that helped make the crisis worse in the United States. So although there are downsides to globalization, global travel, that type of thing, I still think that globalization as a process will continue, although we may see a near-term hit to globalization. All right, the question about the $350 billion allocated to small businesses through the PPP loans, as I mentioned, that's not going to be enough. We're likely to see more about that, the long-term implications of the stimulus bill on the debt burden. We've discussed that. How long do you think it will take for consumers to return to pre-COVID behavior? That's the $64 question. We're assuming that with the stimulus, with the expanded unemployment insurance benefits, with the stimulus checks and so forth, that consumers, once conditions start to return to normal, will be willing to go out and spend, purchase new homes, purchase new cars, that type of thing. But that's as much a psychological issue as it is an economic issue. And maybe consumers are scarred by this. Maybe consumers are scarred because we've had 2 enormous recessions over the past dozen years or so, and that we see a permanently higher savings rate. We see consumers being permanently more cautious, and that does have implications for slower long-term economic growth. So I'm hopeful that we will see consumer activity gradually return to normal, but there is certainly the potential for big shifts in consumer behavior that would result in slower economic growth over the longer run. The real estate market, commercial and retail, I think we covered that. What sectors do you see poised for employment growth over the short and medium term? I think communications, computing industries, we're all working from home. I think that trend is likely to continue, and there's going to be an emphasis on making sure that we have backup systems in place. So I think a lot of that technology, those technologically oriented industries will do better. Obviously, we'll be making investments in healthcare infrastructure to better deal with the next pandemic when it comes along. So those industries should be doing well. a resurgence in higher ed, as we've seen with most recessions. Higher ed, that's an interesting case. I have a college student at home who is taking his classes remotely. Is this going to cause a structural shift in higher education where perhaps this de-emphasizes the need for on-campus instruction? We may see that occur, in which case we would need much less infrastructure for higher education in the United States. Obviously, that's an important industry for the Pittsburgh metropolitan area. So we'll have to see how that plays out. But certainly that does raise questions about the long-term sustainability of the current model of higher education that we have here in the United States. Mortgage forbearance for commercial real estate debt. I'm not going to cover that one. That gets a little bit more of the banking side of things, so I'm going to be cautious in answering that. And then trends that I think this will jumpstart. Again, a lot of more emphasis on telecommunications. Perhaps more emphasis on consumer spending that is more oriented towards at-home services rather than away-from-home purchases. One thing that I do think that this is going to do is, we already had a shift that was underway from purchasing things in person to purchasing things online. Obviously, that has accelerated, and so I think that many of those small retailers, or even some of the big box retailers that were already struggling, this may be the death knell for those small businesses. I think we're going to see an even greater acceleration away from brick and mortar sales towards more online sales as a result of this, and the infrastructure is developed. And then the last question, another drop in the stock market. I'm not a financial markets expert or an investment advisor. What I would say is that investors should get themselves used to still high volatility in the near term, that we are going to see big swings up and down in stock prices in the near term until we have a better sense of how this is going to end and what both the short term and then the longer term damage to the economy are. Stock prices have generally been up over the past couple of weeks, but it's certainly easy to imagine that we get some bad news, whether it's on the coronavirus front, whether it's on corporate guidance, whether it's on the strength of the recovery, what's happening to the labor market that causes stock markets to go down again. I still think that stocks are a good long-run investment, but we're going to have very high volatility in the near term. And I would encourage investors to kind of look through that and focus on the longer run. If you're concerned about the short term, then I would suggest you talk with your financial advisor and see, how you can alleviate some of those concerns. But I still think that over the long run, that stocks will prove to be a good investment. So that looks like all the questions that we have that came in through the chat. So I'll turn it back over to our hosts.
All right. Thank you, Gus. And thank you everyone on attendance to dealing with our mishap with our slides and our presentation. So with that, I think we can sign off for this webinar. Gus, it's been very informative and very needed at this time. And I wish everyone to be able to take care over the next weeks, months, whatever it might be. And, and remember that the IE is a resource for all small businesses, family businesses that we have. So we look forward to serving however we can. You can get in touch by visiting entrepreneur.pitt.edu and finding our contact information there. And we hope to help you and help everyone move along during this time.